We have 3 central bank meetings this upcoming week that will definitely keep investors busy and, of course, volatility high just before the holidays. This is the week ahead at XM.com. Thanks for joining us. I'm Cristina Marujos, and with me today is our senior market analyst, Haralambos Pissouros. Now, Haralambos, starting with the United States, without a doubt, maybe the main event of the week will be the much-anticipated Fed meeting on Wednesday. Markets expect a rate cut this upcoming week. Do you think Fed officials will satisfy those expectations, and how might the dollar respond?
Hello, Christina. Yes, following Wednesday's CPI data, investors became fully convinced that the 25 basis points rate cut will be delivered at this FOMC gathering. However, they have also added to their bets of a January pause, with that probability now rising to around 80%. Now, although several Fed officials appeared willing to lower interest rates now, the stellar performance of the US economy, the resilient labor market, and concerns that Trump's policies could fuel inflation, I think those variables corroborate the notion that the Fed may not need to rush into lowering interest rates, and this was also something noted by Fed Chair Powell himself. So, a 25 basis points rate cut next week is unlikely to shake the markets much. I think that investors may turn their attention to hints and clues on how likely a January pause is and on how many rate cuts policymakers are expecting throughout 2025. Now, taking next week's reduction out of the equation, Fed Fund futures are pointing to another 50 basis points worth of reductions by next December, which poses, in my opinion, some downside risks to the US dollar. And I will explain now what I mean. Even if Fed Chair Powell corroborates the notion that in January pause could be the case, a median dot on the dot plot pointing to more than 50 basis points worth of rate cuts next year could disappoint market expectations and thereby weigh on the greenback.
It's interesting to see what the Fed is planning ahead for 2025. Of course, let's cross into the United Kingdom. The Bank of England also meets this upcoming week, on Thursday to be exact, and it looks like it's not in a rush to cut rates. So what do you think policymakers will signal when they meet, and of course, how might the pound respond?
At their last meeting, British policymakers cut rates, but they raised their inflation projections because Finance Minister Reeves announced massive government spending in her first budget. Now, combined with recent remarks from Governor Bailey that there is still a distance to travel, this prompted investors to anticipate no action before the turn of the year and around 75 basis points worth of reductions by the end of 2025. So, should the Bank of England maintain a hawkish stance that they are in no rush to do so, to continue lowering rates, the pound is likely to remain supported, and it could even finish the year higher against the US dollar if the Fed, as we already noted, disappoints current market expectations.
Well, the pound has been one of the stellar performers of the FX market in 2024. Now let's cross into Japan. We have the Bank of Japan meeting this upcoming week, and it is likely to deliver a rate hike sooner or later. Could we see this rate hike happening this week, and where would that leave the yen?
Expectations about this bank have changed notably lately, Christina. Up until very recently, investors were pricing in a 60% chance for a quarter point hike at this gathering. However, that probability dropped to around 25% after board member Nagamura said that although he's not opposed to rate hikes, the decisions should be data dependent. His remarks disappointed those expecting the Bank of Japan to finish the year with a hike, but yet traders are nearly fully pricing in a quarter point increase by March because Governor Ueda and his colleagues maintained their readiness to hike again due to an expanding economy, rising wages, and above target inflation. This means that there are upside risks for the yen. A rate hike by the Bank of Japan next week could offer strong support, but even if officials decide to stand pat as the market is penciling in now, strong hints and clues that a rate hike at the turn of the year is warranted could still prove beneficial for the Japanese currency.
And before I let you go, Haralambos, do we have any key data coming up this week that investors should keep an eye on?
Yes, Christina, besides those three major central bank decisions, we have the preliminary PMIs from the Eurozone, the UK and the US on Monday. I believe that another round of disappointing prints in the euro area could intensify speculation that the ECB may need to cut aggressively next year and thereby weigh on the euro. Now, with regards to the UK and US prints, I believe they are unlikely. I believe they could have less of a market impact, as pound and dollar traders are likely to keep their gaze locked on the Fed and Bank of England decisions. We get the UK jobs and CPI data on Tuesday and Wednesday, the UK retail sales on Friday. On Friday, we also have the Fed's favorite inflation metric, the core PC index. And 2 days earlier, on Wednesday, Canadian CPI data may add to speculation that after this week's 50 basis points rate cut by the Bank of Canada, Canadian policymakers may prefer to take the sidelines in January, something that could allow the loonie to take a breather.
It's going to be a very busy week indeed. Haralambos, thanks so much. This was The Week Ahead at XM.com.